economic policy uncertainty has shot to new heights following on the announcement of President Donald Trump's Liberation Day tariffs. Now, markets have reacted with volatility to the tariff announcement themselves, as well as each round of deal-making as it has been announced. Joining me today to discuss the impact of these tariff announcements and market reactions in more detail is Chief Investment Officer John Gilchrist. So John, we have seen some big moves from markets, but a key question for investors is, what are the moves that actually matter?
Good morning, Audrey. And as you pointed out, it's been a very, very turbulent year. But bizarrely, if we look year to date through to the mid-May period, if you had gone away on holiday and simply come back in mid-May and looked at the headline indices, you wouldn't have even known anything happened. So if we start off with the equity markets, which is where most investors focus, and in particular when you're looking at global moves driven out of the US, you're going to look at the S&P 500. It's effectively flat year to date from 1 January through to mid-May. Obviously within that we had that significant drawdown. It was down 15% at one stage from the beginning of the year, and that was actually 19% down from the mid-February period. If you have a look at the MSCI World, very, very similar pattern. But then if you move across and you look at Europe, the Euro Stoxx was up very, very strongly January and into early February. So even though we saw those big drawdowns, it's actually up 9.8% year to date in euros. And then if we have a look across emerging markets, you've got the Brazilian market, Bovespa, up 15.1%. Our own market, if we look at the capped SWIX, that's up 8.5%. And then Hong Kong, a proxy essentially for China, is up nearly 17%. Now, all of those are in local currencies, but obviously we do know that the dollar was weak through this period. Those are the markets that most investors are going to have a look at, but really the important markets are the currency markets and the interest rate markets. The dollar on a trade-weighted basis is down 7.2%. Once again, all these numbers are to mid-May year to date. And then very importantly, the 10-year US bond yield has had a really turbulent year. It's traded between 4% and 4.8% as recession fears, as inflation fears, and as fiscal fears came to play. And there was a period where very technical factors also came to play. So a very, very volatile period for essentially the risk-free asset that defines all asset prices across the world. Once again, if you had been on holiday for 5 months and came back, 4.5% is where it started, 4.5% is where the 10-year yield is currently. And then if we have a look at the 30-year US yield, the 30-year bond, that started the year at 4.8% and is very close to breaching 5%. And that for us really is a key indication the markets are concerned about the fiscal situation. So an incredibly turbulent year, but a lot of that fear had dissipated. The VIX, for example, started the year at 18, spiked up massively, and is back at 18. This for us indicates quite a lot of complacency given how big the fundamental underlying changes in markets have actually been.
So, John, can you boil it down for us and explain what are the biggest challenges that investors should be aware of in this environment?
So, as an investor, every time you're looking at markets, it feels like an incredibly difficult environment. There are always risks, there are always things that are top of mind. But I think it's fair to say that right now is one of the most challenging investment environments any of us have faced. I've been in the markets since the late 90s. This is a particularly challenging environment because we do face the prospect of a significant regime change, something that we haven't really seen since the fall of the Berlin Wall. And it's become very apparent through Trump's presidency and in particular the Liberation Day announcements that we're looking at a potential reordering of global trade. We're looking at a very accelerated move to a multipolar world, and we're looking at significant geopolitical implications of that. Now, as these things unfold, the implications can be extreme. And that is a particularly challenging environment for investors. So investors have to not only navigate what is going to potentially happen, what are the implications on individual stocks of tariffs, of trade wars, of the resultant second order effects of that. But also if we take a step back and we look at a high level perspective, we've got the S&P 500, which as we know dominates. It was 74% of the MSCI world at the beginning of this year. It obviously dropped down a little bit as some of those mega cap stocks underperformed, but is roughly back at those sort of levels. So it dominates global indices. It's rebounded. It's back at levels, as I mentioned earlier, where it started the year, and that's an expensive level. And in particular, a number of the shares that dominate that index have really benefited from the environment that we've seen since the GFC. And we do expect that environment is going to be different going forward. Just what has happened to date, even if Trump steps back, there are some significant implications of him rattling the cage. And so the fact that those stocks still dominate that index, given that they were very, very strong performers in a world of globalization, low interest rates, low inflation rates, and low geopolitical tensions, begs some questions. And as I said, the S&P 500 itself is stretched from a valuation perspective. Then you've got the bonds that I referred to. The fiscal situation in the US is particularly challenging. Essentially, we've got a deficit that is continuing to widen out. If you have a look year to date, the monthly numbers come out, that deficit is actually running at higher levels than we've seen at any time since COVID, which was obviously during a recessionary type of environment where that deficit blew out. So despite Doge's efforts, which have clearly been a failure, I think we've gone from 2 trillion to 1 trillion to 160 billion. We've also got debt expanding. We talked about the higher interest rates. So the interest bill on the fiscal side of things is expanding. And ultimately, Trump still needs to put through some tax cuts. So the fiscal situation is a concern that raises questions around the US bonds and whether all these risks are fully priced in. Then you've got another major factor is the fact that there was this exceptionalism, US exceptionalism narrative. We talked about the MSCI world being 74% US dominant, and that has now faded. That exceptionalism narrative has faded. We've seen a flow of assets moving out of the US, both bonds and equities, and finding homes elsewhere. And that's driven some of that differential performance that I referred to right up front. We don't think that is necessarily going to stop overnight. There are a lot of investors that take time to make changes, and so over the medium term and longer term, you're likely to see flows out of the US and into markets that are less liquid, which could drive those asset prices up considerably and put a bit of a cap on US asset prices. And to put it in perspective, at the end of 2024, US investments by foreigners into the US stood at around $34 trillion. This is a very, very large number, and even a small rebalancing on that could have significant implications. And then finally, if we have a look, a lot of global investors run their portfolios on what is called a 60-40 basis, 60% equities, generally S&P or MSCI World benchmarked, and then 40% in bonds dominated by US bonds. In this sort of environment, those investors are cautious. If we have bond yields continuing to rise, if we have inflation driven by trade wars, tariffs, immigration policies, that could put pressure on the bond yields, which then could put pressure on an already extended equity market valuations, downward pressure on that. And so they are concerned about a potential replay of what we saw back in 2020, when the 60-40 portfolios were really hurt by both equities declining and bonds falling at the same time. And the correlation between those is something that investors are grappling with. When we come to local investors, you've got all of this, plus the implications of these back into South Africa, either directly or, for example, if US bonds were to sell off, our bonds could well follow suit, but also the currency implications. And then on top of that, we've got concerns around the GNU, political instability questions, concerns around some of the latest legislation that have gone through, delays on the budget, etc., etc. So there's a lot to really deal with. And finally, questions around Eskom, Transnet, the efficacy of Operation Vulindlela, and are we actually going to continue to see progress versus just talk?
So John, taking all of this volatility into account, how is PSG Asset Management positioning its portfolios for this environment?
Firstly, maybe before I get into that, Audrey, it's important to note that we manage about 63 billion in assets under management across our various capabilities, and that gives us the opportunity to adjust and rebalance those portfolios, and we do that unashamedly. We think it's a key added source of return and risk management for clients. And so the strength that we saw in January and February, and in particular leading into the Liberation Days where we felt there was a risk event that we had to take cognizance of, we used that to actually trim some of our risk assets and some of our equities, and we had decent option protection going into that period. We then saw the Liberation Day announcement. We saw markets coming under extreme pressure, and what we were able to do is assess what had happened and then look for opportunities where the margin of safety had opened up on our shares and we were able to step in and buy them. And so we added certainly into the depth of that despair heading towards the 8th of April. We also actually sold out some of that put option protection we had in place at very, very good levels. The volatilities exploded as fear came into the market, and that boosted the price of those put options. We then obviously saw the markets rebound quite strongly, and once again, as the margin of safety narrowed down on some of our shares, and as we felt the level of complacency in markets was rising, we actually used that as an opportunity to trim some of our risk assets and actually to add to the option positioning. So we are active. We think it is an additive that we bring ultimately for the benefit of our clients. Going back to your question, in terms of the starting point has to be our philosophy, and as you know, we shop in uncrowded areas of the market, out of favor areas of the market. We apply our 3M process, moat management, margin of safety, and as a result, we tend to be in shares and risk assets that we believe are cheap, and that provides an initial level of protection, we believe, in the event that there are turbulent occurrences and that markets recorrect. The other thing that we do, which would be clear from my answers this far, is that we are underweight the US, we are overweight or certainly more invested in Europe, in the UK, and in certain emerging markets, including Hong Kong, Brazil, obviously South Africa. We are cautious in terms of the US fiscal situation. Higher inflation, higher interest rates, higher debt levels could squeeze out that spending and put upward pressure on US bond yields. And so we cautiously positioned overall in the US. And then when it comes to South Africa, we see a very attractive real yields from South African bonds, but the fiscal situation does require higher growth rates to resolve appropriately. And so we are balancing that opportunity with the inherent risks that we see.
So John, you've alluded to PSG Asset Management's 3M investment process, and we pride ourselves on being able to find overlooked opportunities or gems in the market, and also offering that important diversification benefit to our clients. Now, can you tell us where you are finding opportunities at the moment?
Yes, so through the 3M process, we do deep research. We believe it is the cornerstone of our approach. And as a result, we're able to find select opportunities. So it's not necessarily about finding a sector that is particularly attractive. It's about finding those gems, those overlooked gems that meet our 3M criteria. So that as a starting point gives us quite diversified portfolios. But in addition, that deep research, combined with the fact that we're able to invest in certain mid-caps and even sometimes small-cap shares, allows us to identify special situations. And those are situations where the share price or the asset price is going to be driven not by overall market sentiment, but by stock-specific issues. So, for example, a corporate action, a buyout, something like that. And these are particularly attractive because they not only give us attractive upside opportunities and good returns, but they provide exceptional diversification benefits to the portfolios. So examples in our portfolios currently, and we tend to have a good set of these because of our approach, would include AECI, ENX, NAMPAC, TripAdvisor, Telcom, Remgro, etc. And if you have a nice portfolio of those, they're not as driven, they're not as market sensitive, they're more idiosyncratic, and that is really, really attractive. And they tend to fire at different points in time as well. In terms of other opportunities that we are seeing, we talked about the fact that we're seeing great opportunities in certain emerging markets, both on the equity side as well as on the bond side. We've talked for a number of years, and we still see great opportunities in supply-constrained industries, those where demand is incredibly difficult to ascertain, but we know that supply is going to reduce, and the supply has a long lead time, giving us the opportunity to actually do the research and see that for a number of years that supply is going to be constrained. And low supply, even in a relatively muted demand environment, is going to cause higher prices, and that has driven select commodity exposure, including energy. And then finally, when we look at our gold holdings, we've had it as a core portfolio holding for about 2 to 3 years, based on not just the portfolio characteristics of gold, but also some fundamental changes in that environment where central banks, post the invasion of Ukraine by Russia, and the weaponization of the US dollar and US bonds potentially, we've seen central bank buying really increase. That's a great underpin. And so we've had good exposure in that space. Once again, as you would expect, with that massive blow up in price that we saw in April on the gold price, we did trim some of our exposure to that, but it remains a core exposure that we think is absolutely crucial in an environment that could show extreme uncertainty and where the global risk asset, being US bonds, potentially doesn't play the traditional role that it has played.
John, thank you so much for joining me today and helping us understand the environment that we face a little better.
Only a pleasure, Audrey. Thank you.